Pursuits by Skoda, only on Bloomberg Quint.
Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. Well, these are the top headlines that we're tracking at this hour. Nifty and Sensex find some ground after 3 consecutive sessions of decline. Mid-caps underperform while the small-cap index is trading with gains. HDFC and HDFC Bank extend declines, contributing nearly 35 points to the Nifty downside today. Nifty PSU Bank is the worst performing index, with 3 of its biggest constituents, SBI, PNB as well as Bank of Baroda, among the top losers on the index. Kotak Mahindra Bank is the top gainer on the Nifty after its first quarter earnings. The management said it sees no stress on its retail and agri portfolio. And 3 major Nifty companies, HUL, L&T and Zee Entertainment, will report their June quarter earnings today. Good afternoon, Devina. Well, some respite. We're seeing some green ticks for the benchmarks at least.
Yeah, so this is actually quite a heartening sight. Not much, but still no complaining. Even 1/3% higher on the index is well taken. Though we have seen a few jagged edges through the trading session. The morning opened higher, then went down by about 1/3%, and then from there has somewhat stabilized to make it all the way till here at 11,379. But remember, until you're under that 11,600 mark, it's going to be a very sticky situation to be. It is, a distorted structure for the index, according to most technical experts, and they would refrain from taking any sort of big positions, at least on the Nifty and the Bank Nifty. The Bank Nifty will come up next. You can just quickly have that index up as well. That is absolutely flat. In fact, picking up from the lows of the day, but the HDFC twins really putting pressure on the Nifty Bank, and even some of the larger PSUs not doing a whole lot much in today's session. Quickly taking a look at the advanced decline ratio in the broader market snapshot before we move on to the heat map and tell you what's moving or not on the index. So it's a slightly better day for the broader market. The advanced decline ratio in favor of the bulls this afternoon, though the gap is narrowing down slightly, but 813 stocks advancing versus about 686 stocks that are looking weak today. The heat map then, and what's moving on the index, and like we said, it is the pain caused from the banking space and the HDFC twins, which is causing that slow drag on the index, and probably you could have seen a better number than just 1/3% increment if these 2 stocks would have contributed. And even SBI, for one, is down about 1.4%, because of which the PSU banking index is also looking weak. HDFC Limited is down 2%. You've got Indiabulls Housing Finance, which is down 1.5%. HDFC Bank, after yesterday's big drop of about 3.5% to 4%, is down yet again. Auto as a pocket, once again, one step lower from what we've been seeing in the recent past. M&M is in the red. Bajaj Auto is in the red. Zee, ahead of numbers, is trading weak, closer to almost 1% given up. What's in the green and holding steady, where the high point of the day for Kotak Mahindra Bank, post the management commentary. Most brokerages have upheld their calls, as well as target prices have been up for the counter. Power Grid is up 2.5%. Asian Paints, ITC, Titan, consumption-oriented names all stacking up at the top, and some of the IT stocks witnessing some amount of money coming in as well. So TCS up about 0.5%. HCL Tech also doing okay, about 0.5%. But let's take a look at the broader market space then. The mid-cap index and the movers there should come up next. We'll tell you what's contributing there. So starting off first with some gains coming in on Dewan Housing Finance. So that one is up about a good 12% You've got the audited numbers now out, some audited disclosures coming in there. Reliance Capital, Reliance Infrastructure, Endurance Tech is up about 4% Oberoi Realty, Mindtree, all of them holding steady ground. Losers then, Group Finance down a good 4%. You've got Coromandel International on the numbers, which are looking weak, about 3.9%. Punjab National Bank and Aditya Birla Fashion, that's down about 2%. I just want to pull up HDFC Life as well. They've reported its numbers just a few moments ago, and a decent set of numbers. New business premium was up about 47%. Then you had the overall total premium growth of 29%. Margins also picked up. New business margins came up to about 29.2%. Stocks up about 1% in a fall in a market which is not looking all that great for financials at least. But that's what we've got in terms of the overall setup. What's happening in the futures and options space has not been all that good for this series as such. We're going to come to a close on Thursday, but what are the moving parts thereabout? Navneet is going to highlight that for us. Navneet.
Thanks for that, Davina. And that's right. In fact, the July series is turning out to be the worst series of this calendar year. In fact, June was the worst, but June saw just about meager sell-off. But this time around, Nifty is already down 4%. Bank Nifty has seen cuts of about nearly 6%. But talking about the trading action today, some respite definitely seen for the benchmark indices. The rollovers for Nifty stand at about 39%. And we are seeing some bit of OI build-up coming in for the July series futures as well, which is up about 10 to 10.5%. Remember, markets have been falling in the last 4 to 5 sessions off for the series, but the open interest for both Nifty as well as the Bank Nifty futures have come off around 12 to 16% compared to the start of the series. For Bank Nifty in today's trade is seeing some bit of heightened trading action because July open interest is up about 18%. Volatility too has inched higher considering the markets have been falling, and today volatility index has been trading above the mark of 13. Currently it's up about 2.2%. What sort of levels to watch out then till Thursday? If you look at the maximum open interest now for the Thursday expiry, it is at the 11,400 call and the 11,300 put. And going by the premium on both these strikes, the 11,400 call premium is somewhere about 37 points, and so far it's added about 7 lakh shares. And if you look at the premium on the 11,300 put, it's about 14. So combined premium is somewhere between the range of 50 to 55. I'm talking about the average premium for today. And if one were to play a strangle on this, it's giving you a range of about 11,250 on the downside to about 11,450 on the upside till the expiry day. So probably you can watch out for that range. In terms of stock futures, Indiabulls Housing, the reason I've picked up this stock, there is a lot of open interest build-up which is coming for the July series today, though the stock's been trading below all its key moving averages. And today's volume, the stock's lower. Today's volume on the cash side is lower than the average volume of last 20 days. As you can see on the screen, the blue line projects the volume of average volume of last 20 sessions, and the white line is projecting today's cash volume. So it's fallen on low volumes in the cash side, but significant amount of OI build-up has come in on the future side. So watch out for this one. And Kotak Mahindra Bank, remember going into earnings, it was weak. Yesterday it fell about 2.5%. On Friday also the stock was weak, but there has been a recovery after the numbers were in line with what the street was expecting. Trades above 50 DMA right now, and it has seen some fresh long positions coming about. In fact, it's also covered its yesterday's losses, and today's move post the numbers has come in on good amount of volume on the cash side. As you can see, the white line is projecting today's volume vis-a-vis the average volume of last 20 sessions. And lastly, Shriram Transport, watch out for this one. Second straight day of selling has come about. Tomorrow they post their earnings, and there are fresh short positions ahead of the earnings coming about for Shriram Transport. We have seen sell-off here as well, and in fact, if you look at today's fall once again on the cash side, it has come on higher side. July open interest is up 21% ahead of the numbers tomorrow, Davina.
All right, that's a quick setup of the futures and options space. But let's begin with the market-wise. Ajay Tyagi of UTI AMC, he's joining us on the show right now. Ajay, thanks very much for taking out the time. You know, how have you read into the current market cues that we've been seeing over the last few days, the weakness that has brought us down to levels of closer to 11,300? And is there some amount of anxiety amongst clients, and what kind of advice are you giving them?
So, you see, our own reading of the current market situation is that, the market really is seeking growth and that has been falling short across sectors. So, the current bout of anxiety in the market, if I take aside the issues related to surcharge on FPIs, which have been classified as association of persons, then truly the anxiety is on account of lack of growth in the overall economy, and that transmitting into lack of growth for sectors across the economy, including the consumption sectors. And the fact that the government is extremely serious about the fiscal deficit also leaves no room for priming the pump and kickstarting the capex in the economy. So to that extent, the markets are now building in lower growth. As far as we are concerned, I think the very short kind of advice that we always give to our clients is that over a fairly long period of time, equity as an asset class gives you the best outcomes, and therefore each client has to look at his or her own asset allocation by sitting along with their advisors and IFAs, and therefore work out the numbers in terms of how much they have to invest into equity and how much into fixed income. And timing the market usually never helps. So to that extent, this may be a good time for investors who are incrementally putting in money into the markets. But obviously they'll have to look at the medium to long term, which is about 3 to 5 years when they take this decision. Right. Yeah.
Your sectoral preferences and your exposure lies mainly within the financial space, and within the financial space also it's within those larger quality names that have been actually seeing the brunt of the selling pressure this time off. So HDFC Bank, Bajaj Finance, HDFC Limited, Kotak Mahindra Bank and IndusInd Bank are some of your top holdings. How would you say that this probably is something that shouldn't worry you, because a quality name like Bajaj Finance or HDFC Bank does not lose its luster just because it falls 3% for one single day?
Sure. No, actually it doesn't. If you see, the current bout of selling started again on account of slowdown related worries. There is a general slowdown in the economy, and therefore for somebody who's financing consumption, i.e. players like Bajaj Finance, obviously there is this worry about their own advances growth slowing down. Now, see, we have no control over how these banks grow in a particular quarter or in a particular year. I think our view on these banks and some of these high quality NBFCs is predicated on the fact that they are one of the best in terms of their underwriting standards. Their asset quality is pristine. They have strong ability to source credit internally, and then quite frankly underwrite this credit while maintaining strong NIMs, translating into strong ROA outcomes. And I think nothing changes insofar as these vectors are concerned for the high quality names that we are holding. Markets would always have their own mood in terms of sometimes punishing quality, sometimes rewarding quality, but in the fullness of time, I think these are the names which to our mind should lead to one of the best outcomes over the next 3 to 5 years. Yeah.
Okay. Hi Ajay, good afternoon. This is Navneet. What are the cash levels you guys are currently sitting on?
Hi. So actually we don't play around with cash levels. Usually our cash levels remain between 2 to 4% of the fund size. And that's majorly to take care of sudden redemptions or to take care of a precipitous fall in the market where possibly we would get some bargain deals. But other than that, we usually don't take, I must say that we never take cash calls.
Okay, fair enough. So since you guys have maximum exposure to financial services and also I think in the IT pack, are there any sectors that you guys are looking to cut down the exposure, and simultaneously how the markets have corrected, looking to increase exposure in certain sectors?
Yeah, that's a good question. I think interestingly we are finding a lot of opportunities on the auto side. For various reasons, the entire auto sector, which includes auto ancillary, has corrected very sharply over the last 6 to 9 months, and we are clearly seeing some very high quality names there which would stand the test of time, which have a very robust business model, which have strong moats built around their business model, and therefore would again start to show growth as soon as the issues which are plaguing the sector settle down over the next couple of quarters. So we have been and we are looking at increasing exposure to such names. So auto clearly is one sector where we would be interested in increasing our exposure. I think if the correction in some of the names in the financial space that we like continues, we would be tempted to increase exposure there as well.
But why auto? I mean, are you being contrarian out here?
So you see, if you look at the long range data, I'll basically just put across two data points to you. If you look at the long range data in terms of volume growth for both passenger cars as well as two-wheelers, and this data is provided by SIAM right from the 1970s, you would see that for any long-term period, and I define long-term as 5 years and above, you dissect it whichever way you want, you realize that passenger cars have shown a 12% volume growth over the last 40 years, and you slice and dice that, let's say, from any time period to any time period. So let's say 95 to 2005 or 97 to 2004 and so on. Passenger cars have shown a 12% volume CAGR, and two-wheelers have shown about a 11% CAGR. Now, along with this, if I juxtapose this statistic, that despite this strong growth over the last 40 years, India's car penetration is just about 2%, and India's four-wheeler penetration is just about 9%. When the world averages are on the passenger car side 20% plus, you would realize that this growth is basically going to continue for the medium to long term, and therefore what we are witnessing in the last 2 or 3 quarters is an aberration rather than the new normal. So we would see, as soon as the financing related issues are sorted out, we would see the sector starting to show again a normalized 10 to 12% growth, but it's a cyclical sector, so it never would rest at 10-12% like we saw in the 12-month up to September, October of last year. The growth was more like 20% every month, year-on-year growth, and over the last 8-9 months the growth has been -10 to -15%. So it's highly cyclical, being a discretionary item, but the normalized growth should still be a very strong double-digit number.
Okay. Well, the knock-on effect of liquidity crisis has definitely been seen, Ajay, in the auto space. I'm just going back to your first answer. You said market sentiment is weak, and also because of higher surcharge now being levied on FPIs who are registered as non-corporates, that may have spooked the sentiment. So considering that, Ajay, and you got stocks like HDFC Twins, which are heavily owned by these FIs, then do you think the sell-off that the market is seeing post in the last 3 to 4 sessions in these index heavyweights could also be as a result of selling coming in from the FI institutional desk?
Possibly, yes. I would. I mean, of course, we wouldn't have. I wouldn't have specific numbers to prove that. But my conjecture is that some part of the selling is also on account of FPI selling their favorite names, and some of the names that you just spoke about have been their favorite holdings. But I would also haste to add here that we usually look at the fundamentals of the business rather than technical factors like who's selling what and where can the selling be more intense than the others. So from a fundamental perspective, we would say that these are the names which can continue growing their advances book at 15 to 20% while holding on to their margins and while holding on to their credit costs, and therefore keeping their NPAs in a very narrow band. So regardless of the short-term selling, our view on some of these names would remain intact.
All right.
Yeah.
Great chatting with you, Ajay. Really appreciate you taking out the time this afternoon and sharing those thoughts with us. All right, it's a quick market opinion coming in from Ajay Tyagi at UTI AMC. But moving on, let's begin with the newsmakers of the day, starting with earnings. And our research team is here to take us through the expectations. Darshan, Agam and Mishika are joining us right now to take us through the expectations of all the numbers that are lined up for you. Darshan, let's start off first with the expectations from Larsen & Toubro.
Yeah, so 10% top line growth, 20% EBITDA growth and 30% bottom line growth is something that we're looking at, which means EBITDA margin increase of by close to 60 basis points. Now, numbers will come in after market hours today. It's not coming during market hours. The other factor is the order inflow. Now, they've stopped telling what the order number is. Instead, they give buckets. So if you do a calculation, what has happened, we are seeing anywhere between 22,000 crores on the lower end to 39,000 crores on the higher end. So if you take an average or a mean, will come close to 30,000 crores of orders that will come in. Will be lower than what it was last time around, because in the first quarter last time, they did close to 30,000 36,000 crores. Now, one of the key reasons is that elections was there and orders from the state and central governments were lower this time. So infrastructure segment won't contribute that much. A lot of orders have started coming in from Q2, and those were the larger orders. So there was weakness in the first quarter. Secondly, the increasing share of services business will lead to margin expansion. It'll be interesting to see what the management says in terms of the guidance that they had given. Remember, last time they met the guidance. Ahead of that, they had to cut guidance to meet it. 12 to 15% revenue growth, 10 to 12% order inflow growth, and margins of 10.5%. So that all details will come in the press conference after the earnings today.
Okay, thanks a lot, Darshan, for bringing that review of L&T. So 10, 20, 30%, these are the three numbers that Darshan just highlighted. You need to watch out. Okay, on to HUL, India's largest consumer goods maker, will be reporting its numbers today. And Agam standing by to tell us what the street is expecting this time around. Agam, all eyes will be on volume growth and the commentary around the demand environment in the rural market especially.
Sure. We are expecting a quiet quarter from HUL, and to talk about the headline numbers, we're likely to see 7% growth in revenues. Also expecting an expansion in EBITDA margins to around 24.3%, about a 70 basis points improvement, and we're likely to see 12% growth in its bottom line. As you've mentioned, we are going to keep an eye on volumes, which a lot of analysts are currently estimating about 6%, and should it come through, that will be the second straight quarter when we will see single-digit growth for HUL after a long streak of well over 10% growth. In terms of two of its biggest segments, as far as home care is concerned, likely to see growth of around 10 to 11%. And in terms of personal care, we're likely to see about 7% growth. In terms of margins, while we are expecting just a little bit of improvement in gross margins, a bulk of the expansion will come on cost-saving initiatives that the company has been carrying out. We must also remember that when it comes to margins, the Ind AS has not been taken into place as far as restating is concerned in the estimates, so that there could be a change when it comes to the reporting as far as HUL is concerned and the kind of numbers that they have. Finally, of course, we are keeping an eye on how rural demand has panned out in comparison to urban demand, and what that has in store and what implications it has for Hindustan Unilever. But on the whole, we're expecting a quiet quarter.
All right, a quiet quarter for HUL, and I believe the same is the case for Zee as well, that will be reporting its Q1 numbers. Likely that even this time around, the TRI tariff order could hurt subscription for some channels. Mishika, what else are we watching out from Zee?
Yes, Devina, let's first straight look at the important numbers that we need to watch out for in today's results. Their revenues are expected to go up by 9.4% at 1,940 crores versus 1,772 crores. The net profit is to go up by 19% at 388 crores versus 326 crores. And EBITDA is expected to be higher by 12.5% at 611 crores versus 543 crores. Now, margins are expected to remain flat at 31%. Advertisement revenue growth is expected to be muted, mainly weighed down by the impacted reach due to transition into the new tariff order. Also, cautious spending by advertisers, particularly FMCG. Now, advertisement growth can be expected to recover in the second half of FY20 as the business stabilizes. Viewership share of Zee can be affected as due to its absence in the sports genre. Also, the pull from the free-to-air segment. Now, subscription revenue growth, on the other hand, is likely to jump due to the uptake of Zee channels in regional markets. An increase in ARPU in the new tariff regime shall lead to an increase in realizations as well. We can expect EBITDA margins, though, to decline due to higher content costs and digital investments. Also, the stake sale continues to be a key monitorable.
Okay, thanks a lot, Mishika, for bringing that preview with regard to what Zee can post this time around. Remember, the street will also be watching out in case if there is any sort of commentary which comes with regard to the stake sale that the market has been eyeing for really long, because of which the stock's also been volatile. Well, ahead of the numbers, it did go into the green, but currently it's sitting with cuts of over 1%. Moving on, the auditors of Dewan Housing Finance have listed several qualifications and disclaimers to the company's annual financial statement. Remember, the results first released on July 13th were unaudited. In addition, the auditors have thrown significant doubt to company's ability to continue as going concern, as it completely depends on its ability to raise funds now. Vishwanath Nair is standing by to explain the situation. Vishwanath, over to you.
So late Monday night, the debt-laden NBFC DHFL, Dewan Housing Finance Corporation, reported its audited financial results, and that showed a number of issues that its auditors had pointed out. Now, remember that the company has been under stress since September 2018 after the NBFC crisis caught up actually the entire sector, but the company is now trying to come back into business, try and restructure its loans, try and figure out a new investor. So a bunch of things are happening in the company. So let's try and explain, where the company stands at this point and what to look forward to. So according to what we thought, these are the three phrases which could probably define or explain what the company is going through right now and what it expects to do in the next few months. So let's start with the first one, the Gone with the Wind. Now, remember that the auditors had pointed out a number of issues with respect to where DHFL stands at this point in time. So according to the auditors' assessment, the intercorporate deposits, there is no actual light as to what the recoverability of these loans are. And whether the company will be able to pay back its lenders in time. There's also an issue with the loan portfolio that the company carries, as well as the pass-through certificates that the company has given out to some of the other lenders. According to the auditors, there again, there are a bunch of loopholes, and there is no clarity as to whether these are clear, these are in the clear, whether these can be repaid, whether these can be recovered or not. All of these questions are still hanging in the air, and the auditors have said that they really can't define what is going to happen. The next point that the auditors had pointed out is about the deferred tax credit. There again, they've said that there is insufficient evidence to prove the company's assessment with respect to the deferred tax credit, as well as the Cobra Post allegations. According to the auditors, the company did not give them the scope of the investigation that it had carried out on its books to verify some of these allegations made by Cobra Post back in January. So therefore, the suggestions which the auditors had made, those were actually ignored by the board of the company. There's also certain observations made by NHB with respect to the capital at DHFL. There again, the auditors have said that the company has not disclosed what are the actual observations that NHB has made, and therefore they cannot determine the impact of those observations if they don't know what the observations are. Lastly, on the expected credit loss model, the company had, if you remember, had marked down certain loans on its books, especially to the corporate borrowers. Now, according to the auditors, they are unable to comment on the assumptions made by the company because they have not been given the details as to how that model worked and how the company had marked down some of those loans. Now, while all of these problems exist, there is a knight in shining armor waiting for DHFL. What we understand from sources is that Aeon Capital, which is a private equity investor, has had conversations with State Bank of India, which is the lead lender for DHFL, on a possible investment into DHFL. They want to acquire certain equity in the company to try and save the company because that is what is most important. But this investment is dependent on a bunch of things working out for the company, and the main part of which is a debt restructuring plan. Now, according to what the auditors had pointed out, there is limited scope for DHFL to monetize some of the assets that it holds on its books, as well as the company is seeking about 1,200 to 1,500 crore per month from the lending consortium so that it can create fresh assets and then give out the charge to the lenders, thereby maintaining some of its liquidity issues. Remember, since September, the company has paid back about 41,800 crore worth of repayments, but most of that has been achieved through selling of these loans. So it is important to notice then what is left in the company, about 55,000 crore worth of retail and about 32,000 crore worth of corporate loans, whether the company is able to monetize that or not. As part of the restructuring, the company is also seeking that a portion of its liabilities can be converted into equity-like instruments, as well as increase the tenure on some of the loans that it owes to the banks. And all of these discussions will happen in the next few days as the company submits its resolution plan to the lenders, whether lenders accept it or not, whether the plan actually gets implemented, and whether the investor finds it feasible to invest in DHFL or not. All of these questions will be answered in the next few days. The company aims to get back into lending by August, but whether that will happen or not, all of this depends on whether that actual restructuring plan gets approved by the lenders.
That's Dewan Housing Finance, and the stock though in today's session is doing okay for itself, actually up about 14%. That's closer to the highest point of the day. 80 million shares have been traded, 59 on the stock right now. But taking a look at the rest of the market now, it seems to have tapered off a bit, but still holding on to the green, 19 odd points. So off the highs of the day, but nothing much to really talk about at this point. Nifty Bank loses a little more, about 34 points down for the Nifty Bank, but an absolutely flat day of trade. Sacchitanand, Uttekar of Tradebulls, is joining us on the show this afternoon. Sacchitanand, I hope you can hear me, and a very good afternoon to you. So for the index at this point, while obviously it's a slightly sticky situation to be in, while you have a fair bit of downside open for you in terms of if you breach 11,300 and if you also breach that 200-day moving average support. But would you be, of the opinion that these shorter bounces, if at all they do happen, could be played upon on the long side?
Good afternoon. If you look at the Nifty, I think, the way 11,300 support has been respected even today, it is quite commendable. If you look at, from an options data perspective, we have a very strong built-up of around 38 to 40 lakhs of option writers who have still not moved their position. So probably, from an expiry perspective, it will be very crucial of how we recover above 11,400 and whether we sustain above that particular level. So in case if we see a rebound and if we see a sustainable rebound above 11,400, then the trajectory for the expiry opens up right up to say 11,480. So, from a Nifty perspective, I think 11,300 would be a crucial support. In case if that particular support is breached, then probably, we may see a further decline in the counter in the index towards say 11,100, and that particular move can be very swift because that will be a breakdown of a very heavy congestion area. So, if you look at today's session, I think it has been relatively better, and the way 11,300 has been holding on, at least we are optimistic that sooner or later we may see Nifty closing above 11,410. But from a trading perspective, I think the setup is more lucrative right now in Bank Nifty. So if you look at the last three trading sessions, the index was facing pressure just because of HDFC Bank. The way we saw a very ferocious move in the last three trading sessions in HDFC Bank. Today we saw a very smart recovery from its 200-day exponential moving average, and most of the private banking names are have turned into positive and have been trading in the green. So on a conditional basis, I think the setup looks very bright in Bank Nifty. So in case if we see a move above say 29,340 on the spot, some buying would be recommended here. The stop loss for the trade should be placed at 29,220, and an expectation of a move towards say 29,550 could be witnessed in a day or so. So I think Nifty, rather than taking a chance there, I would prefer taking a long call in Bank Nifty, but on a conditional basis about 29,340.
Okay, what about individual stocks, Sacchitanand?
Well, we have three trading recommendations, two on the long side and one on the short side. First one is a buy call in LIC Housing Finance. So if you look at the overall structure, what we have observed here is that a harmonic pattern has been completed here. We are witnessing a double bottom kind of formation near to the low of around 508. We are recommending longs here with a stop loss of 515 in LIC. We are expecting a bounce back towards say 530 levels where its short-term averages are placed. The second call would be a buy call on Jubilant Foods. If you look at the overall structure, the level of around 1190, 1200 has acted as a very strong support area. Multiple times we have seen the stock rebounding from the same. Even in today's session, we saw a very smart recovery from the levels of around 1190. So stop loss for the trade should be placed at 1200, and long positions can be, fresh longs can be added even at this point of time. We are expecting a swift move towards say 1260. The stop loss for the trade would be 1200. But on the short side, REC has been on the declining trend, and the way the mark of around 150 has been providing some supply, we expect that there's still one particular leg which is pending, and the stock may slide towards 143 levels. So with a stop loss of 150, short positions can be recommended or initiated in REC futures. The expectation of this particular move or the validity is just for this particular expiry.
Okay, so those are some individual stock ideas coming your way from Sacchitanand for this afternoon. Let's also get your fundamental views on the market. And joining us now on the show is Jagannathan Thunuguntla of Centrum Broking. Hi, Jagannathan. Good afternoon to you, and thanks a lot for joining us on this show of Bloomberg Quint. Let me start off with the biggie, the top gainer on Nifty, Kotak Mahindra Bank, which is reacting to its numbers. It went into the numbers pretty weak. There was some bit of selling seen, but the numbers have been pretty much in line. I think two factors which majority of the brokerages have also highlighted. One is the loan growth coming sub 20%, which was somewhere about 18% this time around, and the valuations of this company, they remain on the higher side. I believe it's trading somewhere about 4.2 times price to book for this financial year. So what did you make of the numbers? And also keeping Kotak Mahindra's performance in mind, and now HDFC Bank has been falling in last two sessions. If someone has to take a bet in the private banking space, where would you go?
At this moment, obviously, entire banking has been going through very transformative kind of phase. Understandably, quality money is chasing top quality brands, be it HDFC or Kotak. Now the challenge is at the larger picture is that the polarization that we had seen over the last 12 months in terms of money chasing frontline quality names, I think is that polarization is coming off is the major challenge. Because what's happening is that over the last 1 year, as the money was chasing, some of these names have become extremely overvalued. Now, considering entire market mode is risk off, there is a significant chance that some of these names may end up correction. But keeping all those things into aside, once the market sentiment revives, I am sure that be it HDFC or Bajaj or Kotak will be the front names which will have the recovery ahead of everybody else. So to that extent, even if there is a dip, one can take that advantage more from the accumulation point of view. We believe next 3 to 6 months can be challenging for the market, but it can become a phenomenal base for next 3 to 6 years of bull run.
All right, we're in the red now for the equities. You've got the Nifty 50 now down closer to 0.2%, and the Nifty Bank once again starting to look slightly more weak. It's actually quite a free fall there. From the highs that we've seen, both the Nifty and the Bank Nifty resembling the kind of downfall that we've seen over the last few minutes of trade. Should pull up a Reliance Industries to see whether or not this pain is coming in from some of the heavyweights out there, because just a few minutes ago, Reliance Industries was in the green, and now that is down about more than 0.5%. I think this is to do with some of the flashes that are on your screen. Aramco said to be concerned about debt in the proposed structure, which is not really going down too well from an investor standpoint. With these kind of comments coming in, it could pose major hurdles. So that is something that is keeping the stock on the edge. 1272 is where the stock is currently trading at. They said that talks could resume with the compromise, and this is some source-based information that's coming on the Bloomberg. And Reliance is set to work on alternatives for talks with Aramco. So all of these factors, they're exploring a sale of up to 25% stake in the refinery unit, and the concern that Aramco has got is the fact that about the debt in the proposed structure. So that stock pulling the index lower along with itself. I think Reliance was up closer to 1%. Post this news, the stock's down about 0.5% now, 6.2 million shares. A quick word, Jagannathan, on Reliance Industries.
I believe Reliance Industries will be a great wealth creator eventually. But the challenge, as I just mentioned about the polarization that we had witnessed over the last 1 year, that is sort of tapering off. The biggest challenge market is facing is a lack of leadership at this juncture. If Nifty has to give up from this point, we can expect 3 to 6 months can be extremely challenging for erstwhile leaders. So I think to that extent, probably risk-averse mood will be prevalent in some of these frontline names. However, as I said again, after this risk-off mode gets completed, and once the risk-on mode again comes back, these names will be the first names to recover. To that extent, there is no much concern. But yes, in the short to medium term, say 3 to 6 months, there is always a challenge of frontline names coming under pressure, because if the Nifty has to follow the mid-cap path that the mid-caps had seen over the last 12 months, I think some of these names will have to cool off a bit.
All right. Reliance Industries is at 1272 now. Quickly, Sacchitanand, Reliance Industries, a trade possible here?
Well, on an immediate basis, probably a decline, a further decline towards say 1265 would be a better level. But definitely, the stock has formed a base somewhere close to 1245, 1250 mark. But on the higher side, it has been facing consistent supply at around 1300. So, in case if we see that decline towards the 1265, then the reward to risk would be much more clearer. The stop loss for the trade should be placed on at around 1250 on a closing basis, and some longs can be added. The stock needs a good breakout about 1300 levels, and then probably we may see a very strong recovery coming back in this particular counter. But as of now, I think the reward to risk is not that sweet. Probably a decline towards 1265 would be a better level wherein some long positions can be committed.
Okay, remember this is a source-based story of Bloomberg right now, where Reliance was looking to sell about 25% stake in their refinery business to Aramco, and the reason for the stake sale was to bring down their debt levels, which has now risen to about $42 billion. Reliance was looking to fetch about $10 billion by selling 25% stake in its refinery business to Saudi Aramco. I think what the story is also trying to say that Reliance was looking to shift some more debt towards to this deal, and precisely that's the reason why the due diligence could take place again. In fact, it's clearly stated both sides have completed the due diligence for the potential deal, but Aramco has asked its financial advisor to update the due diligence report almost every quarter, and these are source-based information. This is source-based information which is coming on the Bloomberg terminal, and precisely that's the reason why you are seeing some bit of sell-off, from at least from the higher levels for Reliance Industries. We'll get you more update on this one, on how, if this deal actually falls through, how could that impact the stock of Reliance going ahead from, we'll get your views from a couple of analysts. But meanwhile, I just want to address Bank Nifty. It's fallen almost 150 points in trade. 29,128 is the level. So there's been a sharp sell-off which has come in for Bank Nifty just in the last 10 to 15 minutes. Jagannathan, I know I've taken your view in the banking space, but very quickly, what have you made of the commentary that we've received from the management, from the likes of RBL Bank, stating that their credit cost could go up in the coming quarters by 35 to 40 bips? HDFC Bank sounding very cautious with regard to their retail book because of the slowdown that we've seen in the economy.
The level of risk aversion in the market is so high. So considering banks as a space is high beta, when the things go good, banks will be the front runners to take the market up. And the same holds good on the downside as well. And also considering banks contribute 35% weightage in overall Nifty space, I think it's understandable that banks will be leaders both on the upside as well on the downside. And also the commentary from some of the banks has not been that encouraging. And also some of the banks which would have been rock solid outperformers and have been strong performers, say RBL Bank or DCB Bank, and suddenly because crisis has been deepening as well as widening, more and more new groups are coming into trouble and stress. So the asset quality suddenly is appearing weaker even in some of the otherwise quality banks. So that is where the market risk aversion is creeping in. So I think the banks will remain the leaders both for the upswing as well as the downswing. Investors have to be extremely careful for the high beta nature of the banking.
Should pull up an RBL Bank. I mean, the stock, the kind of steep sell-off that it has witnessed, I think somewhere in the month of May had made a high closer to 716. Post that did come off, came down to levels of about 620. But the kind of sell-off that has happened over the last 1 week, that's been incessant. And the stock's now at about 62 rather. The last 7 days, 30% given up. Management commentary absolutely painting a bleak picture, and that's not taken too kindly for investors as well. Quick word, Sacchitanand, RBL looking oversold, but would you probably look at selling it further, because it doesn't look like there is a cap on the downside?
Well, there are no significant levels here, but if you look at the overall momentum of this particular stock, clearly that it has been with the trend. Even right now, the way it was shaping a recovery, it failed to sustain above the 480 mark. And again, if you look at the intraday, 30-minute scale, again we have a pen and breakdown. So probably, we may see this particular move extending right up to say, 450, 445 zone, where we have, some signs of, historical supports. But definitely, from a trading perspective, some short positions can be, considered here. If you look at a reversal, I think the stock should, close above 480. Then probably we may see, a meaningful recovery coming back in the counter. But I think the way it has broken down again, I think a stop loss somewhere close to 472 would be ideal for a price target of around 450.
Okay, and we'll talk about RBL Bank, and Darshan will highlight that for us too in terms of the commentary that management gave. From a bigger standpoint, the Indian markets, which have failed to make any head start since the earnings season, and what kind of commentary has this got about from all of the managements that have reported numbers? Because that seems to be slightly disappointing. Darshan, all of the numbers that have come out, private sector banks particularly, they've really challenged valuations for even the larger names.
Yeah, so basically if you take a look at the numbers that have come out, the numbers haven't been that disappointing, but you've seen the cuts of 15-20% in banks like RBL Bank, DCB Bank, Mindtree, Cyient. Yeah. It's basically because of the commentary that it has gone down. Now, we've compiled a list of all the stocks or the companies in which the data was disappointing. RBL Bank has said that NPS could rise from 1.38% to almost 2.5% over the next 3 quarters, and the counter shaved off almost more than 120 rupees ever since the numbers came out, so that is weak. DCB Bank says that 5 accounts are causing them stress, and 2 of them could come in, could fall over the next 2 quarters, so that is something that is of a worry. Yes Bank wasn't cautious, the numbers were really bad, but the management guidance is something that the street doesn't believe at this point of time, and the counter over the past few days has been slightly sideways. Federal Bank fell post a decent set of numbers. They're saying that the higher gross NPL formation is seen on the SME segment. They've lowered the loan growth target. Karnataka Bank says exposure to Syntex and DHFL is something of a little bit of worry to them. That was something. And the big boy HDFC Bank itself said that they're seeing stress in the agri portfolio, and that counter was down over 5% in trade. So there is weakness. The other pack was the mid-cap IT. You saw how Cyient didn't give any guidance because they're seeing weakness in the defense and the communication space. The other one being Mindtree, which actually saw pockets of weakness exist. Overall, they expect it to be strong, but the numbers were really bad for Mindtree, and it's down for reasons in terms of management change. The other 2 L&T subsidiaries, Infotech said that earnings will improve only in the 3rd quarter. L&T Tech has cut the guidance for their revenue, so that is indicating of weakness. Now, Dabur came out with a very strong set of numbers, 9.6% volume growth compared to the estimate of 5%, but they've cited demand headwind and competitive intensity, which will mean that the full year volume growth will be close to 5 to 6%, which means the next 3 quarters won't be as strong. The other one was Bajaj Consumer saying that demand hasn't picked up yet. Interglobe Aviation spoke about yields falling because prices have fallen in the 2nd quarter. ACC, most of the brokerages say that it was only on account of a price hike that the counter did well in trade, that the results came in well, probably should reverse. Dhanuka Agritech saying that sowing season is delayed due to the late onset of monsoon. So across the sectors, while the numbers haven't been that disappointing, the commentary is something that has been of a big disappointment.
All right, Darshan, thanks very much for that. But on to our Bloomberg exclusive. Reliance Industries and Aramco's deal is set to have hit a roadblock. Anto Anthony of Bloomberg News is joining us right now on the phone line with more. Anto, just run us through, how big of a setback this is, and also what is the next course of action? I mean, we are hearing source-based news talking about resumption on the basis of some compromise and the alternatives that are there in front of Reliance and Aramco.
Yeah, that's right. So the deal talks between Reliance Industries and Saudi Aramco has stuck over the deal's structure. Aramco has expressed some concerns about Reliance's proposal to shift some debt of the wider group to its refinery business ahead of the transaction. So as of now, the Reliance is working on alternatives and negotiations could still resume, but we don't know how much time it could take. But once a compromise is reached, they can restart the negotiations.
And the biggest hurdle is related to the debt, right? Is what has been stated as?
Yes, that's right. Like Reliance has planned to shift part of the debt from the wider group into the refinery business, in which Aramco will be buying the stake. And we are told that that is the stumbling block right now. So Reliance and Aramco can work alternative structures to tide over this situation.
Okay, Anto, we leave it at that. Thank you so very much for joining us with those details. So I don't know how much time this is going to take, but Reliance's intention to move part of their debt into the refinery business, which they intend to sell 25% off to Aramco. That's a little bit of a contentious point there in this particular deal, and that's causing the roadblock. But no timeline yet as to or probably what exactly the alternatives are that could be under discussion or consideration. Not really very clear out there. The stock though has worsened a bit. It's down about 1%.
Yeah, that may not be a good news. In fact, if this doesn't go through, remember Reliance has been looking at deleveraging exercise in order to reduce its debt, and it has taken a lot of steps in order to reduce the debt, which has gone up after investing money in its telecom business in Reliance Jio. The stock, however, is trading with cuts of 1%. Just want to highlight few stocks before we move ahead. Asian Paints, pull up that stock that's trading with some bit of gains today. And remember, I think the earnings for this one come out tomorrow. It's off the day's high, but still it's sitting with gains about closer to 2%. Sacchitanand, if I could come to you on the charts at 1430 for Asian Paints, ahead of the numbers, would you take a bet here?
In fact, we were expecting a move towards say 1450, and the way this particular move has shaped up, I would rather recommend booking profits and getting into a trade once the resistance of 1455 is cleared. So probably in case someone is holding any longs, I think it's better to be light ahead of the results. In case if the result reaction has becomes positive, and if we see the stock trading comfortably above say 1455, then probably we may reconsider the trade. But as of now, I think the stock has already seen a very good up move, and it is nearing the resistance area before the event, so it's better to be on the sidelines and book profits.
Okay. That's the technical view on Asian Paints. Jagannathan, before we thank you, anything from the earnings so far which has stood out for you?
I feel from the long-term point of view, we are very bullish on insurance as a space. Stay invested for next 10-15 years and don't get bothered about the quarterly, two-quarterly kind of performance. Already we had witnessed the kind of bounce in HDFC Life or the SBI Life. It's a great theme, and insurance is exactly the place where banking was some 15-20 years back. And also we feel that in the BFSI, going forward, the importance of I will increase, whereas B as a banking obviously has created enormous wealth. There will be a saturation point beyond a point. So I think there will be more and more focus on the I. So don't miss the opportunity. So don't build this insurance portfolio for you. Build it for your kids. I'm sure there is a lot of money to be made because already some of them have created enormous wealth. I feel a long way to go. Stay focused on insurance, I feel, and don't get bothered by quarterly numbers. That hardly matters in the theme like insurance.
Okay, Jagannathan, you have given this view earlier also to us. Thanks a lot for sharing that view on the insurance pack, where you remain pretty bullish from a longer term perspective. Appreciate you joining us today and sharing your thoughts with us. Okay, index is at 11,310. Remember, we have defended that mark twice just in the recent past, and remains to be seen if this gets breached today. And Bank Nifty is inching very closer to the mark of 29,000, which is down almost 200 points in trade. We'll slip into a short break, but before that, Samir Arora of Helios Capital finds no motivation to buy Indian equities in the current scenario. Speaking to Bloomberg Quint earlier today, Arora said he expects the markets to bottom out in the next 6 months.
I don't think the selling is necessarily related to this tax, because the pain of tax will be, and that is the sad part, it will be not visible to you, as in to anybody. forever. But when you get $5 billion inflows, please remember you could have got 10. And when you get 10 one day, please remember that time that you could have got 15. But if anybody thinks that it will be forgotten in a bull market, actually it will be exaggerated in a bull market, this tax. So let's just see. So right now, it doesn't matter to an investor whether he's paying tax or not, because he's not making any money in the first place. But let us say a year like 2017 comes up, which will come up one day, and the market goes up 30%, and therefore the guy who's paying taxes goes up 26% because he's paid an average of 15 to 20%, whatever, 22% tax. So he's gone up 25%. At that time, he will think that he's done as well as the index, but he would be 5% lower than the index. So the ETFs, people will stop looking at Indian ETFs, because without analyzing, they will think that these ETFs are not able to replicate the index that we have asked them to replicate. And generally, in a bull market, if you lose 4 or 5% relative to the index, and broadly the bull market, when it happens, will be in all markets, hopefully, you will on the margin keep losing investors who will think that the Indian market, the cost of, because it's a cost, because 50, 60, 70% of these investors don't pay taxes in their home countries also, because they are either sovereign funds, pension funds, or they are from Singapore or Hong Kong or somewhere else. And even in US, it is not clear how they will take tax credit for taxes paid in India. So basically, this is a cost of investing in India. It's like a expense ratio going up 200, 300, 400 basis points in a bull year. How can anybody manage that? It's very difficult. Right now, nobody realizes this, not because the tax is lower, but because the pre-tax income is not high enough to make any difference to anybody.
Is this sentiment a bit worrying? The lack of interest to actually enter even after the markets have corrected about 600 to 700 points from its highs, and the sitting on the fence kind of an attitude?
Well, that is also correct in some sense, because these things somebody can still ignore if the market, independent of this, is doing so well that somebody says, okay, I will make less, but I'm making 10, so I'll make 8. Okay, let us say, and it's an expense also, let us say. Even then people would come in, some people would come in. It's not, that's a problem. We will never be able to know the cost of this, except because it's not that you will have massive outflows every year. So if you get, as I said, 10, you should have got 20. That is my theory. But right now you need something else to go on, and I feel that will happen in the next 6 months, because I think this market will bottom not today, tomorrow, but maybe in October, November period, for a few reasons. One is that the slowdown in the NBFC crisis started in September last year, and therefore in that sense you can say that the numbers will be in the base when we look at the last quarter, this October-December quarter and moving forward. Secondly, we would have had 2 bad years, 18 and 19, even though in 18 the index seemed to be up, and even now it seems to be up, but we know it's not really at a broader market level. And we rarely had 2 bad years since I've been a fund manager in 93, from 93. I think only in 2000 and 2001 did we have 2 consecutive bad years. And also, if we say that the markets discount at least 6 months ahead of time, then in a sense you're even covering the following 6 months, that even if the slowdown is there. Right now, there doesn't seem to be any motivation for anybody to start buying, because they are in a bad market, you are upsetting them. So it's like double whammy.